Capital plc. So Capital plc has an authorised share capital of €800,000 divided into 600,000 ordinary shares at €1 each and 200,000 8% preference shares at €1 each. The following trial balance was extracted from the books at the 31st of the 12th, 2017. So you've got your trial balance there with all of your account balances at the end of the year. The following information is relevant. Number 1, stock on the 31st of the 12th, 2017 was €86,000. Number 2, the patent was acquired on the 1st of the 1st, 2014 for €63,000. It is being amortised over 9 years in equal instalments. This amortisation is to be included in the cost of sales. Number 3, provision should be made for debenture interest due, investment income due, auditor's fees, director's fees and corporation tax. So auditor's fees €16,000, director's fees €32,000 and corporation tax €49,000. Number 4, included in distribution costs is the receipt of €15,000 for patent royalties. Number 5, during the year, land adjacent to the company's premises, which had cost €80,000, was sold for €167,000. At the end of the year, the company revalued its buildings to €850,000 and wishes to incorporate this value in this year's accounts. Number 6, depreciation on buildings is to be provided at the rate of 2% per annum straight line and is to be allocated 40% to distribution costs and 60% to administration expenses. There was no purchase or sale of buildings during the year. Delivery vans are to be depreciated at the rate of 20% per annum on a reducing balance basis. Number 7, the company is being sued by a former employee who is claiming unfair dismissal and is seeking damages of €100,000. Company legal advisors have stated that it is unlikely that any compensation will have to be paid to the former employee. The company has received an invoice for legal fees to the value of €5,000 which must be provided for. On the 31st of the 12th, 2017, Capital plc entered into a preliminary contract agreement with Stewart's Limited, a construction company, to build an extension to its premises at a cost of €400,000. It also intends to carry out improvements to existing premises at a cost of €120,000. Required, Part A. Prepare the published profit and loss account for the year ended 31st of the 12th, 2017 and a balance sheet as at that date in accordance with the Companies Acts and appropriate accounting standards showing the following notes. Number 1, accounting policy note for tangible fixed assets and stock. Number 2, operating profit. Number 3, dividends. Number 4, capital expenditure commitments note. And number 5, tangible fixed assets, and that is for 90 marks there. And then Part B, explain how an auditor safeguards the interests of shareholders for 10 marks. Okay, so first step I would say to you is to prepare the layout of the trading profit and loss and the balance sheet using the format that you're asked to do, okay, in the Companies Act. All right. So you've got your turnover, cost of sales, gross profit, distribution costs, administration expenses, other operating income, operating profit, exceptional item, income from financial investments, interest payable, profit on ordinary activities before taxation, tax on profit on ordinary activities, profit on ordinary activities after taxation, dividends paid, retained profit, profit and loss balance 1st the 1st, 2000 and whatever, profit and loss balance 31st of the 12th, 2000 whatever. And then you have your balance sheet of whatever PLC as at the 31st of the 12th, 2000 and whatever. So you've got your fixed assets, under which you've got your intangible assets, your tangible assets, your financial assets, and then you have current assets where you have your stock, debtors and bank. And then creditors, you have amounts falling due within 1 year, you have trade creditors, and you have other creditors, and then you have taxation. And then that is equal to net current assets, and then you've got your total assets less current liabilities. The last section, you have creditors, amounts falling due after 1 year, and you've got your whatever percentage debentures in there. Then you have capital and reserves, you have issued shares, you have revaluation reserve, and you have profit and loss balance. Here, I would recommend that you put your tangible fixed assets working there. Okay, so you should be doing this at the same time as you're doing your P&L and your balance sheet, because it's going to save you time in the long run. Okay, so let's get started. So step 2, enter the figures from the trial balance, and that should take you 6 minutes. All right, so we'll get started now. So this is how your published P&L and your balance sheet is going to look, and your tangible fixed assets, when you've put in all of the figures from the trial balance. Okay, so I would just suggest that being your second step, okay, so that you won't leave any figures out whatsoever. So make sure that you're ticking off the figures from the trial balance as you're going along. So we'll go back to the start, and I'm just going to show you where all of these figures came from. So first here you've got your delivery vans at cost, and I would suggest putting that into your tangible fixed assets working there, cost on the first. Then you have your accumulated depreciation, 116,000, which will go here, accumulated depreciation 116, which means then that you can work out that your net book value is 164,000. Then you have 6% investments, so 300,000 here. All right, and what you would need to remember to do here is we would work out how much investment income we'll get for the year, but just make a note that you're probably more than likely going to have investment income due, because you'll have that in every single question. Now, buildings at cost here, €760,000. Now, what we have is €840 here, 840,000 here. Why is it not 760,000 as is here? Well, this here says buildings at cost, and this here is land and buildings. So if you look down later on in the question, which we've previously read out, number 5 said during the year, land adjacent to the company's premises, which had cost €80,000, was sold for €167,000. So they had land that cost €80,000. So therefore, this 840 is the 80,000 and the 760. So that is why that is a little bit different there. Then you have buildings, accumulated depreciation, 81,300, which you put in here. 840,000 minus 81,300 is equal to €758,700. Then we have investment income. So this investment income, 8,400, that is the amount that we have received, but we can work out in a wee minute what might be due. So investment income due. So we know what our investments were up here. We'll have to work that out later on, or we can work it out now. Whenever you want to do it, it's absolutely fine. Then you have your debtors and creditors, 139,000 and 108,000. So your debtors here goes into your debtors working. So your debtors is everybody who owes you money, okay? Whereas if you see here under creditors, you have the trade creditors, which are the people who you buy goods on credit from. And then your other creditors are just everybody else that you owe money to. So scanning down through the question, all right, there wasn't any other notes got to do with trade creditors. So therefore, I just slot that 108,000 in. So you kind of get used to this as you read down through the question. You're already identifying, is anything going to affect that? And there was nothing that affected creditors. And you can practice that as you go along and see these questions. You'll see sometimes if you can identify figures that can just go straight into the accounts. Then you have opening stock on the 1st of the 1st, 91,000. So that is going to go into your cost of sales working there. Okay, so cost of sales is going to go up here, and that is 91,000 then on the 1st of the 1st. Okay, so then you have patent on the 1st of the 1st. And so the patent on the 1st of the 1st is €42,000. So €42,000, we'll just throw it into a wee work in there, and we'll figure that out later on then. Then we have administration expenses, €205,000. So into your admin expenses, €205,000. Then we have distribution costs, €144,000. So €144,000 goes into distribution costs. Then you have purchases and sales. So your purchases goes into your cost of sales heading. Okay, you're working for that, 1,170,000. And your sales will be going into turnover, so 1.800300 million. Then you have carriage inwards. So carriage inwards would appear in the cost of sales heading in your trading profit and loss. So carriage inwards, we plus carriage inwards, 6,600 there. Then you have returns inwards. So this is sales returns. So sales returns, that is going to be taken away from the turnover. So minus 20,300 there. So that is where sales returns goes, returns inwards. Then you have rental income. So rental income is next. It's on the credit side where incomes go. So 28,000, that is going to go into other operating income. So here's other operating income here. So any other income that is not sales, but it has got to do with the operations of the business. Next we have profit on sale of land. Okay, so that is an exceptional item. So if you looked at your theory for published accounts, it is a profit or loss of significant size, such as the profit or sale on the sale of land, or it could be a really large bad debt as well. Then you have dividends paid, 55,000 euro. Then we have bank, 82,000 euro. So bank is another one that a lot of the time can just go straight into the accounts, because we read down through the question already, there was no other mention of bank anywhere else. So 82,000 euro straight into your current assets there. Then you have VAT, and VAT, as you know, current liability there because it's on the credit side. VAT will go under the taxation heading. So taxation is here. Then we have the profit and loss, okay, 42,500. Now, when a profit figure is on the debit side, that means that it is a loss. If a profit figure was on the credit side, that means that it is a profit. So profit is a liability to the owner, and liabilities go on the credit side. So profit is on the credit side, it's a liability to the owner, and they made a profit. Losses go on the debit side. So then we have issued capital. So we have 720,000 euro there. Okay, issued capital. Then we have provision for bad debts. So provision for bad debts, 28,500 here. So we take that away from our debtors. So usually it comes away from our debtors in our question 1. So we're going to take it away from debtors here as well. Then we have the 7% debentures, 300,000 euro. So 7% debentures, 300,000 euro there. Then we have discount. Discount, as you can see, is on the credit side. So discount on the debit side, okay, this side here, would be discount allowed. That would be an expense given to customers. So a discount allowed is an expense. Discount received is an income. Incomes go on the credit side. So discount received will be added to other operating income here, 39,000 euro there. Then we have debenture interest paid, 13,300. Now we're going to work out in the next step how much the debenture interest should be in total, but more than likely we're going to have debenture interest due, and that will go into our other creditors here in the creditors minus 1 year. Okay, so that is all of the figures entered in there from the published profit and loss and the balance sheet account. So you do need to learn off your layout first of all. Okay, that's very, very, very important. And then slotting in the figures, you will earn substantial marks for that. And the workings on this question is very, very, very easy. So it really is the layout that is the most important and tricky part to get. So step 3, I'm going to say that we will look for the investment income, all right, and the debenture interest, and then the amounts due as well. Now, they will ask for in this question, they have always asked for you to provide for investment income due, debenture interest due, but not every question on your course is going to do that. So I think it's good practice to learn to calculate these all the time, kind of at the start before you look at your adjustments. So let's have a look here. The investment was 300,000 euro multiplied by 6%, and then we bought them only with 9 months of the year to go. Okay, so we're 3 months into the year whenever we bought them, so bought on the 1st of the 4th. So therefore, that is 13,500 euro can go straight in here. That is the investment income for the year. Then the interest payable is 300,000 by 7%, which is 21,000 euro. So we minus 21,000 euro here. Now, in the trial balance earlier on, we were told that we had received some investment income and that we had received some debenture interest. However, we didn't receive all of it, or we didn't pay all of it. So 13,500 minus the amount that it says that we have received in the trial balance is 5,100 euro. Okay, so investment income due, 5,100 euro there into debtors. Then into other creditors, we have the debenture interest due. So it is the 21,000 for the year minus the amount that we have paid, which was disclosed in the trial balance, and that is the debenture interest due. So that is the amount that we need to pay still, so 7,700. And where will these items go? So anybody that owes us any money goes into debtors in the current assets, and anybody that we owe money to goes under other creditors in creditors amounts fallen due within 1 year. So that's the third thing that I would suggest that you do. Step 4 then would be to start your adjustments, and I would say, take 15 minutes for this. You'll find that you'll probably get them done a lot quicker than that once you have practiced these questions a few times. So number 1, stock on the 31st of 12, 2017 was 86,000. So this is closing stock. Where does closing stock go in your trading profit and loss? It goes into your cost of sales. Where does it go in your balance sheet? It goes into your stock, okay, into your current assets. So this is how it's going to look. So stock in current assets, 86,000 here. And then stock, closing stock in the workings, it will go under cost of sales, and we minus closing stock, 86,000 there. So that's number 1 done. Number 2, the patent was acquired on the 1st of the 1st, 2014 for 63,000 euro. It is being amortised over 9 years in equal instalments. This amortisation is to be included in the cost of sales. So, patent acquired a few years ago there for 63,000, being written off over 9 years, so that's 7,000 euro each year. And they're saying that the €7 is to be included in the cost of sales. So how is this going to look in our accounts? Well, in our patent here, we've got 42,000 minus 7,000 patent written off, and that's 35,000 that is going to be in our balance sheet, 35,000 fixed assets there. And then we were told it is to be incorporated into our cost of sales, so plus 7,000 patent written off there. So that's note 2 done. Note 3 then says, provision should be made for debenture interest due, which we've already done, investment income due, we've already done, auditor's fees, 16,000 euro, director's fees, 32,000 euro, and corporation tax, 49,000 euro. So when you see provision to be made for, we have not done this yet, okay? So we need to do that now. So we've already done our investment income due and our debenture interest due, but what we have to say, we have to put in our auditor's fees. So 16,000 auditor's fees are going to go into administration expenses. And now we haven't paid for them yet, so therefore we have to put them into other creditors then in the balance sheet. So we owe this. And then director's fees need to be paid. So director's fees are also an administration expense. So 32,000 needs to be added on there. And then that also needs to be paid. So it hasn't been paid yet. So we plus director's fees, 32,000 there. All right. Then the tax, corporation tax needs to be paid, which hasn't been paid yet. So 34,200, your VAT that's already there. We're going to add our 49,000 corporation tax to that. Now, hopefully you will know that the tax that we put in here into our published P&L is corporation tax. So 49,000 corporation tax needs to be taken away there in our published profit and loss account. Now, that's note 3 done. Note 4, included in distribution costs is the receipt of 15,000 euro for patent royalties. Okay, I would love it if you would draw a T account and write down distribution costs. Okay, and I want you to think about what side of the T account would you enter that distribution costs, what side would you enter that? You would enter it into the debit side. Why? Because debit side are expenses and distribution costs are expenses. So that would be debit side of distribution costs is where you record them. Now, if in our distribution costs, if you could change the colour of your pen, if you would write in patent royalties is an income. What side do we put incomes on? We put them on the credit side. We put them on the opposite side, on the credit side. So incomes are credited, expenses are debited. If you put an income into an expense account, that is doing the completely wrong thing, okay? An income needs to go into an income account. It needs to go into its own account. All right, so you need to know your alert diagram in order to do that. So your alert diagram, which has all of the double entry rules. Okay, so how do we get rid of this 15,000 patent royalties from distribution costs? Well, funnily enough, we have to add them, right? You might think we need to take them away, but because distribution costs are debited and patent royalties would have been credited, that would have reduced the amount of our distribution costs that is shown in the trial balance. So we need to add 15,000 to distribution costs, and then we'll add the 15,000 patent royalties to where it should have went, which was add operating income. So see here, distribution costs, add patent royalties, 15,000, and then other operating income, patent royalties are added there into where they actually should have went in the first place. Okay, so it's funny, a lot of people minus the patent royalties, but you need to know your double entry rules in order to get that right. Expenses are debited, revenues are credited, and revenues should go into their own account. They shouldn't go into anybody else's account. So complete error there. Okay, note 5. During the year, land adjacent to the company's premises, which had cost €80,000, was sold for €167,000. At the end of the year, the company revalued its buildings to €850,000 and wishes to incorporate this value in this year's accounts. Okay, right, so during the year, land adjacent, which had cost 80,000, was sold for 167,000. At the end of the year, they're going to revalue the buildings to 850, and they wish to incorporate this value into this year's accounts. Okay, so the profit that was made, 87,000. There doesn't appear to be any other exceptional item in this question, so we'll just throw the 87,000 into exceptional item. Now, in our tangible fixed assets working here, we are going to minus the 80,000 land that was sold. And what we're also going to do is we're also going to say €850,000 is what the cost is now. Okay, so €850,000. And we're going to put in down here net book value at the end of the year, 850,000 again. Okay, so we'll be putting 90,000 into this revaluation surplus, and we'll be working it out in total once we've done the depreciation and put that in here. Okay, so that is all you have to do there. Note 6 then says, depreciation on buildings is to be provided at the rate of 2% per annum straight line and is to be allocated 40% to distribution costs and 60% to administration expenses. There was no purchase or sale of buildings during the year. Delivery vans are to be depreciated at the rate of 20% per annum on a reducing balance basis. Okay, so good bit of work here to do. So depreciation in buildings, 2% straight line, and then we have to separate it out, 40% to distribution costs, 60% to administration expenses. So that is on cost. So delivery vans, there was no purchase or sale of buildings during the year as well, important to note. Delivery vans depreciated 20% on a reducing balance basis. So that basically means whatever they are worth now. So the net book value of the buildings. Okay, so let's go and calculate this out. So the depreciation of buildings. So the buildings cost €760,000. Multiply that by 2% of cost, so that's 15,200. And now remember, that needs to be split up 40% into distribution. So that's 6080, which is going to be added to distribution, as you can see here, plus 6080. And then 60% is going to go into admin, so 9120 into admin. So to your admin expenses plus 9120. Then you've got your depreciation on delivery vans. So now we were doing it on reducing balance basis, so it's on the net book value of the delivery vans, and we worked out earlier on that the net book value was 164,000 because they cost 280,000, but the depreciation on them was 116,000. So therefore, net book value 164,000. So 164,000 by 20% is 32,800 euro. And that goes straight into distribution costs, 32,800 euro there. Now, then you're going to put that into your tangible fixed assets working. So your charge for the year for delivery vans, 32,800, and then your charge for your buildings, 15,200. So that is that adjustment done. The next adjustment, adjustment 7, says the company is being sued by a former employee who is claiming unfair dismissal and is seeking damages of 100,000 euro. Company legal advisors have stated that it is unlikely that any compensation will have to be paid to the former employee. The company has received an invoice for legal fees to the value of 5,000 euro, which must be provided for. So, it's unlikely that the business is going to have to pay this compensation out to the employee. So therefore, we don't need to put that 100,000 into the accounts. All right. But what we do have to put in is the 5,000 legal fees, which they haven't paid for yet. So they're owed that. Okay. The legal people are owed that, so we need to put that into other creditors. Now you need to think about where would you put 5,000 legal fees? That's an admin expense. So again, unfair dismissal, anything like that, is a contingent liability. So it's a possible obligation depending on whether some uncertain future event occurs, or a present obligation but payment is not probable, or the amount cannot be measured reliably. So it's just probable and subject to reasonable estimation. We put it into the financial statements. If it's probable that we'll have to pay it, but not in this case, we don't. If it's reasonably possible, we'll put it into the notes, but it's not possible. We've been told that we're not going to have to pay it, so therefore we don't have to put it in at all. Okay, so we don't have to do provision for it in the accounts at all. So we have here legal fees in our admin expenses plus 5,000 euro here, and then we haven't paid it yet, so we're going to add that into our other creditors, so people that we owe. So everybody that we owe is going into other creditors, everybody that's not our trade creditors or the taxman. Okay, and then the last one there, note 8, on the 31st of the 12th, 2017, Capital plc entered into a preliminary contract agreement with Cirrus Limited, a construction company, to build an extension to its premises at a cost of 400,000 euro. It also intends to carry out improvements to existing premises at a cost of 120,000 euro. Now, we don't have to enter that into the accounts at all because it's only a preliminary agreement. They haven't signed, sealed and delivered and all this, so you don't have to enter that in at all. But we did read earlier that it will be part of the notes. Okay, so what we'll do now is we'll tot up our tangible fixed assets working. So I'll just show you how to do the revaluation reserve. So delivery vans, just looking at this first, 280, we didn't sell any, okay, and there was no purchase or anything during the year, so 280,000 euro was in there. The accumulated depreciation, tot all that up. When we take from 280,000 euro these two sums of depreciation, our net book value at the end of the year is 131,200. With our land and buildings, we had 840,000 euros worth at the start of the year. Then we sold a field for 80,000. And then the new value at the end of the year was 850 after it was revalued. That is a jump of 90,000 between the cost and the new value. And then when we're looking at the depreciation, 81,300 plus 15,200, we need to unwind any of that depreciation. So that adds up to 96,500. So therefore, 90,000 and 96,500 is 186,500, which is the revaluation reserve there. In the total column, all we're doing is we're totting the two amounts up, and that's it. This, when we get down to the bottom, this figure here, the 981,200, is the tangible assets figure here in the balance sheet. So that's how you do that. The next step is to tot up all of your totals. So your final published profit and loss and the balance sheet should look like that. So pause the video if you're doing the question along with me and just make sure that you've got all of the same figures there. Step 6 now is to complete the notes to the accounts. So I'd say about seven minutes to do this. All right. So the notes there that we're looking for was note 1, accounting policy note for tangible fixed assets and stock, note 2, operating profit, note 3, dividends, note 4, capital expenditure commitments note, and note 5, tangible fixed assets. So accounting policy notes for tangible fixed assets and stock. So you need to learn off these layouts, all right? So have a look at the video on the notes for published accounts if you don't know them yet. So buildings were revalued at the end of 2017 and were included in the accounts at their revalued amount. Delivery vans were shown at cost. Depreciation is calculated in order to write off the value or cost of the tangible assets over their estimated useful economic life as follows. Buildings, 2% per annum, straight line basis. Vehicles, 20% per annum, reducing balance basis. Stocks are valued on a first in, first out basis at the lower of cost and net realisable value. Operating profit. So operating profit is arrived at after charging depreciation on tangible fixed assets. So if we add up the depreciation on the delivery vans and the land and buildings, we would get 48,000, which we'll see in our tangible fixed assets note as well. The patent amortised or written off, which we took from note 2, was €7,000. The director's fees was actually €32,000. Sorry, I wrote 22 by accident, so €32,000, which you see in note 3. The auditor's fees, €16,000, which you get in note 3 also, and then the legal fees, which we look at in note 7, were €5,000. Now, we have to do the dividends. So what we need to do here is say how much ordinary dividends were paid out and how much preference dividends were paid out and how much cent were paid per share as well. So total dividends here were 55,000, and we know here issued capital ordinary shares, we've got 600,000 ordinary shares at €1 each, and we've got 200,000 8% preference shares at €1 each as well. So all the shares are €1 each. So 8% of 120,000 is €9,600. So that is how much the preference shareholders were paid. How do I know that? Well, there's a fixed percentage that they must be paid. So that is 9,600. So 120,000 multiplied by 8%, 9,600. Now, how do I find out how many cent per share? I divide that 9,600 by the number of shares, and the number of shares are 120,000, and I know that because the shares are €1 each. Now, if I have paid 9,600 to the preference shareholders, how much have I paid to the ordinary shareholders? How do I find that out? Well, if the total dividends paid were €55,000, as you can see here, €55,000 minus 9,600 is 45,400. And then I divide that by my number of ordinary shares, which is €600,000, and that works out at 7.57 cent per share. So that's the dividends done. The next one is capital commitments note. So the company has entered into a preliminary contract with Stewart Limited for the building of an extension to its premises for the sum of €400,000. They also intend to carry out further capital improvements to existing premises at a cost of €120,000. So just capital is once-off long-term spending, and the benefits are going to last longer than a year for a company. So what commitments have they entered into? Well, they've entered into that commitment with the building contractor. Then your final note was your tangible fixed assets, and we have done that throughout the question, so hopefully you'll know how to do that one. Then you are on to your theory, and you have about 4 minutes to complete this theory then. So part B, for 10 marks, explain how an auditor safeguards the interests of shareholders. So they examine the financial statements and give an assurance that they give a true and fair view. By preparing an audit report and giving an assurance that the financial statements have been prepared in accordance with the Companies Acts and accounting standards and practices. By being able to threaten a qualified audit report, thereby discouraging fraud. Being independent of the directors, the auditor is appointed by the shareholders and is responsible to them. So that is the 2018 published accounts question complete.